Investors Monday took advantage of calmer market conditions and recent weakness in riskier assets to plunge headlong into higher-yielding corporate debt and stocks. By the afternoon, however, caution set in as analysts say headwinds such as geopolitical tensions in the Middle East, as well as ongoing uncertainties over the U.S.-China trade dispute, aren't going anywhere anytime too soon. A soft March jobs report released Friday also didn't help matters much, and the S&P 500 ended the session gaining just a little more than 0.3% to finish the day at 2613. With the recent volatility eased back somewhat, all eyes have turned to the upcoming CPI data. The Bureau of Labor Statistics is set to release the March CPI tomorrow morning, and investors worry a strong reading could weigh on bond prices and hammer stocks further. What threat does the CPI pose? Well, not too much, unless the number comes in stronger than expected. Analysts widely expect the CPI ex-food and energy will come in at a rise of 0.2% in March over the previous month. Strategists at Blue Line Futures say the year-on-year read will also be closely watched as a 2.1% increase is expected, which would be the highest level since February 2017. Why are these figures important? According to Blue Line Futures, stronger than expected data will lift the US dollar and will likely put pressure on equity markets. This also wouldn't be good for bonds. Blue Line Futures say that if CPI comes in merely in line with expectations, it won't be enough to push the Federal Reserve faster than priced in. However, it will surely get the conversation going and place a lot of emphasis on next month's data. Meanwhile, weak data would reinvigorate the dollar bears, but also help support equity markets, as this would take pressure off of the Fed and question 3 rate hikes this year. For now, prices of higher-yielding corporate bonds have been generally resilient to the recent rise in volatility and have largely dismissed retail fund withdrawals. For the week ending April 4th, Lipper reported $573 million having left retail funds. While this continued a trend of recent outflows, it doesn't seem to have affected prices. The high-yield CDX index, a gauge of junk bond sentiment, was tighter Monday by around 5.9 basis points to around 350 basis points, with cash bonds having narrowed on the day by nearly 2.5 basis points to an OAS of around 352 basis points. Junk bonds have also been outperforming equities, which some strategists say may signal a further downturn in the stock market. John Kozer, chief market strategist at Asbury Research, for example, recently observed a relative underperformance by equity prices on the SPDR S&P 500 ETF, widely known as the SPY index, compared to junk bond prices in the Barclays Capital High Yield Bond ETF under ticker JNK, which he argues is historically characteristic of near-term stock market declines. Kozer noted that SPY began a trend of monthly relative underperformance versus JNK on March 19th, and a previous similar trend of relative underperformance had coincided with the February 8th drop in the SPX to 2581. Look for the March CPI, due out Wednesday at 8:30 a.m. Eastern Time. In the meantime, visit the IB Traders Inside platform to hear more about what our contributors are saying about the state of the market. I'm Steve Levine for Interactive Brokers.